Hi, and welcome to this morning's early global view. It is currently 7:30 a.m. U.S. Central Time on Wednesday, March 2nd, 2015. And we're coming to you a little bit later than usual because we wanted to see this morning's U.S. ADP jobs number. And that was very interesting in that it was better than expected. About 30,000 better, 214 versus a 185 estimate, even if last month's was downgraded to 193,000 from the original 205,000. But the important point here is that we're seeing still weak international data for the most part, and yet the U.S. data has improved of late, as we'll note shortly. So it's a bit of a Goldilocks matrix for the U.S. equities insofar as the U.S. improvement is allowing for some hopeful expectations at the same time that the international weakness is still creating a bad news is good news sort of restraint on the Fed. Very interesting. So we have to ask, what has all this meant to the markets? Well, at least for now, that's still very limited but somewhat weaker overseas data today has left the S&P 500 March contract, as usual, hourly on the left, 30-minute on the right, down 6 at 1972. Now, it's important that this is backed off a bit because the key resistance up here, and we'll see this on the weekly chart shortly, is the 1970 to 1975 area. So on a bear squeeze late yesterday, they pushed above it. Now the question is where they continue higher. Now, if they do, the next major resistance is not till up in the 2010 to 2020 range, but along the way there are interim resistances at old gaps we'll see on the daily chart up around the 1986 area and again up around 1995. And of course, as we move forward through today into tomorrow, we do have this topping line on the hourly chart coming in anywhere late today in the 1992 into mid-session tomorrow up around 1998. And the other thing that's notable here is just looking back a week ago, how much lower this market was on the nervous response to the energy market weakness, but even that, after the spill Tuesday into Wednesday, only put it down around the low end of this gap, 1992 to 90 area, and once it started cleaning up back above 1902, it was back on track. The point here is that this market is railing like a bear. It's not tending to grind higher the way bull markets do, but rather starts going up again on squeezing the bears once it can't stay down on breaks, much as we saw this week Monday, when the sell-off back into the key 1932 to 25 area held, and once it gapped higher yesterday, it was going to be very hard to stop it, especially once it got back above the 1950 area. And that pretty much does it for the short-term view of the S&P 500.